Well, thank you, Simon, and many thanks to Case Schroers and to William Mason to inviting me to this event and to speak to you all today. But also thank you for inviting me to Guernsey full stop. I travel quite a lot because of my international engagements, and I usually tend to spend a lot of time in the hotel trying to get work done. But I found it a bit hard because your island is so gorgeous, and the bailiwick as well. So thank you very much for having me here. So, here today, as Simon and William said, I'm addressing you in my capacity as chair of the Executive Committee of the International Association of Insurance Supervisors. The day job is Executive Director for policy, prudential policy for banks and insurance at the Bank of England. But back to the IAS, I don't know if you know, but William is a very active member of the IAS Executive Committee, and he also chairs the Audit and Risk Committee of the IAS. So he's one of the reasons that I can sleep relatively peacefully at night, because he's at the helm of the Risk Committee. So thank you for that as well, William. Now, my focus today will not be on innovation or Brexit, but on the third aspect of this conference's theme, international standards, and specifically how the IAS's work as a global standard setter can help support international trade. Now, this is an issue that is becoming increasingly more relevant, and in my view, it will be a very important issue in the years ahead. Now, just to demonstrate how important it is, I will give you an example and remind you of a set of speeches several central bankers and others have been giving recently. Now, every year in August, there is an annual gathering of central bankers and academic economists, a number of you may know, in the Federal Reserve Bank of Kansas City in Jackson Hole. And analysts and investment banks and strategists follow it very closely because they expect one of the key central bankers to make a key announcement about the direction of interest rates in either the dollar area or the euro area. But this year, they were very disappointed because the speeches did not focus so much on monetary policy, but on the importance of financial regulation in supporting economic growth, openness, and trade in financial services. And just to give you some examples, in her speech, Janet Yellen, the outgoing chair of the Board of Governors of the Federal Reserve System, went through the empirical evidence that shows that the more prudent financial regulation that has been adopted post the global financial crisis has protected financial systems from adverse shocks, as you would expect, but also has supported global growth. This is what the bulk of the economic evidence suggests. In the same event, the governor of, the president actually, of the European Central Bank, Mario Draghi, focused on openness as a key ingredient for stronger growth and considered the role of global standard setting bodies, such as the Financial Stability Board and the various Basel committees, in mitigating what he called the collateral damage that can come from unfettered openness in trade, including through regulatory races to the bottom, financial instability, and financial crisis. Now, these statements that were made in August relate to earlier speeches by my own governor, Mark Carney, in April and in Mansion House in June, where he outlined the choice ahead of us between what he called the high road of an open, responsible global financial system which combines robust international standards and trust built through transparent implementation and intensive supervisory cooperation. This, in Mark's view, creates a system of enhanced equivalence and mutual deference, leading to freer and more efficient movement of capital and financial services being brought more fully into trade agreements, which, as you know, focus on goods mostly. Mark also said that the alternative choice available is the low road, in which trust and cooperation diminish, fragmentation hardens, capital flows are disrupted, and trade and innovation are curtailed. More recently, in October, again at Mansion House, Sam Woods, the chief executive of the PRA within the Bank of England, and my boss actually, explored the related issue of the impact of geography on finance, which he dubbed geofinance. Sam distinguished between retail financial services, where some domestication, for example in the UK through ring fencing, is associated with net social benefits, and wholesale financial services, where fragmentation can lead to net social costs through increasing significantly the cost of raising capital globally. Sam said, "It is best to deepen cooperation so that between us we can properly supervise wholesale banking through branches as well as subsidiaries. This will be challenging, but progress since the crisis shows it can be done. Governments and regulators come together through the FSB in a spirit of cooperative resolve and enlightened self-interest to build the framework of global standards." Now, as Draghi said in Jackson Hole, there is a growing disaffection amongst people in OECD countries with the openness necessary for what Mark called the high road. International standard-setting institutions like the IIS have an increasingly important role in tackling and helping protect people from the unwelcome consequences of openness to ensure we do not lapse into protectionist over time. International standards can support openness through making cross-border trade in financial services fairer and safer. Now, irrespective of the particular form of the United Kingdom's future relationship with the EU, the Bank of England, through its Financial Policy Committee, has made publicly clear its commitment to the implementation of robust prudential standards. This commitment extends to meeting international standards. As chair of the IIS's Executive Committee, I would like to focus the rest of my remarks today on how the IIS's work reflects these calls to foster greater trust, openness, and cooperation. The IIS has made progress on the following core activities, and we shall continue to make progress. First, monitoring and tackling known and emerging risks to the insurance sector. Second, developing global standards that should enable greater comparability and support a level playing field, and therefore fairness. Third, improving cooperation between regulators, including supporting our members to build the capacity and skills they need to deliver effective supervision. And fourth, ensuring our work actually makes a difference in practice through assessing the implementation of IIS standards and using these evaluations to inform the design of new and redesign of existing standards. Each of these activities, we hope, contributes to the journey along the high road that the Governor spoke about. Let me touch upon each of these four areas. First, monitoring and tackling known risks. By its very nature, standard setting is a catching up game. We set standards for risks we have already observed and identified. But these can quickly become stale if we are not alert to emerging risks and opportunities in our sector. At the IIS, we are aware of that, and that is why we have issued papers and done work on cybersecurity and fintech, and we're doing more. Another example is the increasing risks posed by natural disasters across the world, the role of reinsurance in this area, and risks from climate change. I know that this area is very close to many of you in Guernsey, in particular with respect to alternative reinsurance and the use of insurance-linked securities. Now, natural disasters place significant burden on the fiscal capacity of affected governments, the broader economy, and most importantly, citizens. Total losses have increased fivefold since the 1980s to around 170 billion US dollars today. Over the same period, the average annual protection gap has widened quickly from 23 billion US dollars to 100 billion US dollars. So the opportunities there are immense. Our Global Insurance Market Report, released earlier this year, included a special topic on reinsurance and climate change and its implications for insurance regulation and supervision. In 2018, we will work with the UN Environment Inquiry's Sustainable Insurance Forum to develop lessons for supervisory practice and climate-related financial disclosures that mitigate risk and support sustainability. Turning next to another area of risk, systemic risk. The IAS has developed since 2013 and currently operates a firm-by-firm or entities-based assessment to support the identification of globally systemically important insurance firms by the Financial Stability Board. But more recently, we have started development of the first activities-based approach to the mitigation of systemic risk in the insurance sector. We intend to publish an initial consultation paper on this by the end of the year. Now, what is an activities-based approach? Our thinking builds on our earlier work to identify potentially systemic insurance product features, what we branded non-traditional, non-insurance products. And these are essentially features that lead to synthetic leverage through macroeconomic exposures and liquidity risk. Now, what are these? Across the global insurance market, macroeconomic exposures arise when the industry in a particular jurisdiction writes large volumes of market risk guarantees into their policy, for example, by offering long-term benefit guarantees backed by short-term assets. Long-term liabilities, short-term assets. Such guarantees are a form of synthetic leverage, of course, because they embed a financial derivative in the policy without the insurer holding the underlying assets. Now, if you have a macro shock, such as a sharp and unanticipated change in interest rates or equity prices, this could lead to shortfalls arising simultaneously across policies. In such cases, a single insurer may not be systemically significant on the basis of its own capital shortfall, but as a contributor to the aggregate capital shortfall stemming from these shocks. The IAS is considering the extent to which prudential measures, such as risk-based capital requirements, including the Insurance Capital Standard, or ICS, that we are developing, already serve to address such risks so as to avoid double counting. A few words about liquidity risk. Examples of activity that involve liquidity risk in insurance include engaging in derivatives contracts with margining requirements, writing insurance policies with discretionary withdrawal characteristics, and of course, securities lending. These three activities have the potential to generate sudden demands for cash or liquid assets. Insurance then may be forced to sell assets to raise cash to meet liquidity needs, increasing market volatility, or triggering adverse spillovers to other institutions. All these activities were, of course, related to AIG's downfall and the subsequent bailout during the global financial crisis. In this area, possible policy measures could, for instance, include liquidity guidance or even liquidity standards. Now, turning to another area, turning away from risks and to global standard setting. As you will be aware, here in Guernsey, which is, according to the IMF, the largest international insurance center in Europe, insurance has become increasingly international in recent years at a rate, the opposite trend, actually, to banking. However, the international regulatory framework has not kept pace with these changes. the current international landscape has all the shortcomings of the EU landscape prior to Solvency II. Many diverse regulatory systems operating in parallel. In the absence of a common glossary, a common language, this makes risk management by and supervision of international firms far more complex and costly than it needs to be. Supervisors essentially don't understand each other. The IAS has been acutely aware of this problem and began to address it in 2013. We have been working towards the development of a single global insurance capital standard, I referred to it earlier, the ICS, aimed at improving transparency while reducing operational costs over time for all stakeholders involved. The aim is for the ICS to enhance supervisory cooperation by creating this common language between home and host supervisors when assessing solvency, dramatically reducing analytical complexity and the opportunities for regulatory arbitrage across jurisdictions. Having published ICS version 1.0 for field testing in June, the IAS made significant progress towards achieving its aims of a single ICS by agreeing its vision for the implementation of ICS version 2.0 at our annual conference earlier this month in Kuala Lumpur, what we call the Kuala Lumpur Agreement. According to this agreement, ICS version 2.0 will be conducted in two phases. First, there will be a 5-year monitoring period during which ICS version 2.0 will be used for confidential reporting to group-wide supervisors in supervisory colleges. There are about 55 internationally active insurance groups with supervisory colleges, and ICS will be used for confidential reporting in these colleges. During this monitoring period, the ICS will not be used as a prescribed capital requirement. That is, if you breach it, there will be no supervisory consequences. But after that monitoring period, the IAS will consider whether refinements are needed, and it will then implement the ICS as a group-wide prescribed capital requirement. ICS version 2.0 contains two equally important components: mandatory confidential reporting by all internationally active insurance groups, as I mentioned, of a highly converged reference ICS. This will be based on a market-adjusted valuation. Solvency II has a market-adjusted valuation, as many of you know. The standard method of capital requirements and converged criteria for the determination of capital resources. The second element is additional reporting at the option of the group-wide supervisor of ICS based on accounting plus valuation and/or an internal model-based capital requirement calculation. In parallel, we have agreed that the IAS will collect data at the discretion of the group-wide supervisor to support the development of an aggregation-based group capital calculation by interested jurisdictions. This follows the announcement by the US National Association of Insurance Commissioners and the Federal Reserve Board that they intend to develop a group capital calculation along these lines in their jurisdiction. By the end of the monitoring period, the IAS will assess whether the aggregation method provides comparable, that is, substantially the same outcomes to the ICS. If so, it will be considered an outcome equivalent approach for implementation of ICS as a prescribed capital requirement. This agreement helps move the IAS towards its ultimate goal of creating a single international capital standard for insurance firms, globally active insurance firms. This goal is some way away, but we have now agreed a way to move towards it. We had to work hard to reach this agreement, and the reason is simple. Some of our members on the executive committee have developed over the years highly sophisticated but also highly divergent standards and practices. To see this, just compare Solvency II, which is what the European Union has adopted, and the RBC, which is what the states supervisors in the US do. Very, very different. Reaching agreement on an international standard when these areas have such different approaches is difficult, and it involves robust and at times very heated arguments. It's essentially a negotiation, albeit a technocratic one. And as in any negotiation, the key ingredients for a successful outcome are the ability and willingness to understand the position of each party, and a mutual belief, and that is key, that in a cooperative outcome, no one will get the first best, but everyone will be ultimately better off. I'm glad to say that in Kuala Lumpur earlier this month, the key ingredients were available, allowing us to bake a cooperative cake to sustain us while we climb the high road, and there is still a lot of climbing to do. Now, while we do not intend for the ICS to apply outside internationally active insurance groups, the 55 or so I mentioned, the development of the ICS embedded in COMFRAME and the insurance core principles will be embedded in COMFRAME and the insurance core principles to eliminate potential inconsistencies. So in parallel to the development of the ICS, the quantitative standard, we're also updating COMFRAME and the relevant ICPs, which are of course very relevant to Guernsey. This year, we consulted on several key themes: governance, the role of supervisors, and supervisory measures, supervisory cooperation, and coordination and resolution. We plan to consult COMFRAME and the relevant ICPs in its entirety mid-next year, on schedule for delivery in 2019. Turning now to the third activity, supervisory cooperation. This is another key area of focus for the IAS and clearly key to help us climb the highway. We have a process for increasing coordination between our members, the IIS Multilateral Memorandum of Understanding, which enables supervisors to exchange relevant information and provide assistance to signatories promoting supervisory cooperation. In 2017, we continued to add new signatories to the Multilateral Memorandum of Understanding, with a number now standing at 64 member organizations, representing more than 70% of global premia, with 12 more in the validation process right now. Guernsey, of course, became a signatory back in 2010. We have also launched a number of other initiatives to help our members work with each other and with partner organizations, such as Access to Insurance and the Financial Stability Institute of the Bank of International Settlements in Basel, to address their supervisory challenges. So this is capacity building. Now, last but not least, our activities on implementation, an area where William has been very active as well. How standards are delivered in practice should inform any revisions as well as the development of new standards. Our implementation and assessment work is of increasing importance as we finalize our post-crisis regulatory framework, including COMFRAME and the ICS. But also because the IMF's FSAP work is likely to reduce in scale, despite the continuing appetite of our members for such assessments. So we need to fill the gap. Now, we already undertake a significant amount of work in this area. Over the last 5 years, we have completed over 1,000 assessments involving 130 different supervisory authorities. However, to reflect the increased importance of our assessment work, we revised the mandate of our implementation committee early in the year to make our renewed focus explicit. And we have approved 3 new developments to give all our members better access to tools and contribute to stronger understanding and observance of our supervisory material. These include a new self-assessment tool that will enable members to self-assess their observance against our ICPs, which is online, an enhanced self-assessment and peer review program. We do that already, but it's enhanced. and the pilot, and this is entirely new, member assessment process to address the demand for comprehensive, intensive and credible assessments of our supervisory material, and to thus fill the gap that the IMF will leave. So in summary, this is all I had to say today on our work. I hope I have given you a sense of what we are doing and what we plan to do to support our members take the high road towards a more open, safer and fairer global financial system. Thank you very much.